Hey everyone, hope you're doing well today. This is Garrett Gunderson, Chief Wealth Architect here at Wealth Factory. So I love the overwhelming response of people that are investing time and signing up in these types of webinars so that we can provide some value for you. As was said in the email, I want to reiterate, there's nothing to buy on this. This is simply us as part of the Wealth Factory family reaching out as part of our mission to liberate 1 million people to become economically independent and help them to see that there's certain rules that a lot of people have been playing by in finance, and really the rules are rigged against most people because we're trained, taught, and educated to invest early, often, and always, that compound interest will save us, that the accumulation method is the right thing to do, just to set money aside, be in it for the long haul, buy, hold, and pray, as we take high risk to get high returns. And you know what we've found is this has absolutely failed people, and this failed financial system has provided a lot of stress and frustration and angst and divorce and a lot of destruction in our society. And I think we have pretty big problems out there today, and we don't need to exacerbate those problems with faulty financial advice. Now, I get why some of this financial advice exists. Part of the reason is because of the commission structures. It creates what I would call a moral hazard, where people want to do the right thing, but they're not incentivized to do the right thing because what they're really emphasizing is retirement planning, which is different than financial planning. Retirement planning is putting money in retirement plans like 401ks or RSPs in Canada, or whether that's thrift savings plans or Keoghs or Simples or SEPs or any of these plans that are really government sponsored, which are really designed to separate you from your money. You set your money aside on a regular basis, wait for 30 years or longer, and then you can finally live off the interest. Well, think about that. The institutions love this because not only do they get to earn on your money, they're taking their fees on the government's money as well because you put it in pre-tax. And what do you want as an institution? You want people's money. You want it on a regular basis. You want to hold on to it for as long as possible and give back the least possible. Well, that's not the win then play way. For you, for them it is, because it didn't take money from them to make money. It took your money for them to make fees. They make money whether your money goes up or down, even though they're incentivized for it to go up. So you stay longer and they make more because the percentage stays the same on a larger amount of money. But I got to tell you, when I was 22 years old, I had kind of this eye-opening, mind-bending, and blowing experience as I took the first trip to New York to see what was going on in Wall Street. So my intention was to go shadow someone. And there was this advanced course that he was hosting where you'd have a certain credentials and be around in the financial business for a certain amount of time, which I had neither. So I was desperately wanting to get in that room because look, I was going through some pain from previous years. See, I put my family and friends and their parents into all these financial programs that were primarily related to the stock market, like mutual funds and variable universal life type things. And as they put their money in there, it was great in 98 and 99. The market was going up and all ships rise with the tide. But the reality was, when the market started to go down, I didn't have the answers. I was being told that I should tell them, oh, the market's on sale. Well, that sucks because it went on sale before they bought, or to dollar cost average. But I haven't met people that want to be average. Most people that want to work with us want to be more extraordinary, want to live a wealthy life, want to live their legacy, want to do something of consequence and impact, not just to be average. And the dollar cost averaging is kind of, once again, rigged against you because you're just putting your money aside every single month, regardless of what happens in the market. Sometimes the shares are higher, sometimes they're lower. So over time, you'll buy at an average price, right? These kind of notions sicken me, especially the notion of you're in it for the long haul, because some of my great aunts and some of my family wasn't really in it for the long haul. They were already in their retirement ages. And now all of a sudden the market wasn't cooperating. And I didn't know, how long will the market stay down? What's causing this market downturn and what's going to turn that around? And ultimately, how much money will be transferred along the way, will be reported as loss that will leave their accounts and go into someone else's account. And who are these someone else? What are they doing differently? You know, I knew about options trading where there's puts and calls. Put is you think something's going to go down, so you buy a put on it, and if it goes down, you make the money. A call is you think something's going to go up, so you say, look, I'm going to buy it on margin and leverage this, so if it goes up, I have even more return. And ultimately, it's a win-lose scenario. It's a zero-sum game. And a lot of people have been playing by these rules, very competitive in nature. Now, some have been lulled to sleep just to hand their money over to, I mean, when we think about Wall Street, do we get warm, fuzzy feelings like, ooh, they have our best interests at heart. This is going to be a great thing for us. But somehow we're convinced through preachers and teachers and family and friends and well-intentioned people and financial professionals to set our money aside into companies we don't know, we don't understand, we don't have an exit strategy for. There's no immediate cash flow. There's tons of fees that are coming out. And sometimes there's government structures that prevent us from accessing our cash. So this is an important state of wealth webinar, because what I want to do is peel back the layer and give you that same kind of insight that I was able to get, that I started to see there was a different set of rules. And there's a way to rig the game positively and ethically in your favor. There's a way to make money on the buy, to focus more on cash flow, to understand what institutions have done to be more profitable and implement those same things in your life. But in order to do that, let's see what were these discoveries, okay? So this is Garrett Gunderson, Chief Wealth Architect, author of Killing Sacred Cows, which talks about 9 financial myths that most people abide by because it's what people want to sell us, but not what's always in our best interest. And so, you know, as we unveil this, I just want you to take a consideration of how well this has been working for you. If you've been able to protect your downside, if you're more of a cash flow or accumulation investor, if you've got higher interest rates that you're paying towards institutions than the interest rates you're earning from those institutions, and if that's actually helping you get ahead, I want you to consider the amount of stress you have around your finances. Does it feel simple and elegant or complex, and you just hand it over and hope that it works out for the best? And what if it doesn't? How much time do you spend earning this money? How much time do you invest in yourself? What does it take to earn this cash after you pay taxes and after you deal with market downturns? And does it get you the life that you want? And is there a way to have that life along the way? And if you understand these different set of rules, can you flip the script? Can you all of a sudden have it benefit you rather than harm you? These are what we want to explore. So let's begin with one of the more famous investors out there. And most people think of this investor as a stock market investor. Now, one thing is for sure, the ultra wealthy have access to guys like Ray Dalio, who wrote the book Principles, who was illuminated inside of Tony Robbins' book, Money Master the Game. And here's a guy that's got 32% returns, but you have to have $100 million minimum to get in with his hedge fund. And he wasn't taking money for a while, and it was really for this network of billionaires essentially. So he had extraordinary returns because he was a hedge fund. A hedge fund is very different than a mutual fund. See, a mutual fund is really what they peddle to the middle class. And even worse, they peddle middle class mutual funds that have high fees, expense ratios to pay for fund managers that don't always beat the benchmark. And after 20 or 30 years, 96% of the time, they're underperforming what's happening in ETFs like exchange traded funds or index funds, because the fees don't justify the performance. And so mutual funds are hamstrung, they're handcuffed. And this is where a lot of people get stuck, because if you're putting your money in an aggressive growth mutual fund, or you're hoping that it's going to get high returns, so it's even just a growth mutual fund, they cannot move to bonds, or they can't move to cash in a time where the market's not performing. And so what happens is you have unnecessary loss and exposure during downturns because of the restricted nature and provisions and objectives of the fund. It's legal, it's fiduciary. Even if they know better, they have to stick with that. Jeffrey Vinnick worked for Fidelity. He ran the Magellan Fund in the 90s. In 1998, he moved it to bonds and to cash, but it was a growth fund, and he moved it a little bit early just before October, and October had a downturn, right? That October had a downturn, and when that downturn happened, you know what? He was right, but he was early, so he was already fired. They had already moved the money back into growth, and they experienced that downturn. So look, this is the state of wealth for May of 2019. And I got to let you know, and as we discuss this, we're talking mutual funds versus hedge funds. We're going to talk about family offices. We're going to talk about where the wealthy are holding their money, how they make their money, and really kind of unveil this. But I'm beginning with kind of the wealthy have access to hedge funds. And even people we think are stock market investors aren't stock market investors. And recently I was in a conversation, and someone's like, how do you know all this? How do you know so? Like, how did you discover all this? Well, let me let you in on a little bit of a secret. I don't know all this just because I sit and research all day. I have 2 kids. That makes it hard to read sometimes. I'm writing a book. It's hard to read in the middle of writing at times. And so it's not always by me doing massive research. I've got people like Ryan, who's a massive researcher, who's a registered investment advisor within our accredited network. Or I've got, everyone from Todd Langford, who just sent me a killer article on charitable trusts, and Kim Butler, who are in the financial business, sending me information, right? Or Tim Carden will find an article and he'll say, hey, you should check this out and see how this works. Or I could just go through how many people are consistently sending me articles within my own financial network, or even the meetings I have saying, hey, did you hear about this? I was on the phone with the guy Derek today, with my brother-in-law, and we were talking about ways that people can get money out of retirement plans without the penalties. And so it's called the Quadro. So we were just talking about these concepts because people are consistently bringing them to me. And it gives me an advantage because now I can sift, sort, and screen just the right things, get really clear on those, and help you out. So Elon says killing sacred cows was profoundly life-changing for him. So glad to hear that, man. I love hearing that. And you know what? Anyone can ask questions because I'm going to cover the content, but I'm going to go through questions. That's one of the benefits for those of you that are on live versus those of you that watch the replay, is you get a chance to tap in and ask these questions. So, I mean, the last time someone got a full day with me was $25,000, and all of a sudden you just have access to it because you've subscribed and you're part of what we're up to, and we're helping, arm you with the right things to become economically independent. So hedge fund versus mutual fund, one of the things I saw with the ultra wealthy. And really the hedge fund, they considered more about downside protection, hedging risk, not being solely reliant upon growth stocks in the stock market. They recognize that high risk, it doesn't equal high return. It equals a chance of loss. I mean, banks know this. Banks are saying if you want to get a mortgage, they want to see a down payment so that they have more security and less exposure. If you don't do a big enough down payment, they'll charge you a higher interest rate for a second mortgage or charge you PMI, which is private mortgage insurance. They want to see your taxes. They want to see your credit score. They want to get an appraisal. These are all things that mitigate and manage risk. And the wealthy people have a financial team that really does due diligence, where the middle class and the poor people, they have financial advisors that get paid commission on transactions. It's impossible to do due diligence when you're getting paid on the transaction. It's just not possible. Even great people, they're going to be stuck in that situation. I love your book, man. What Would the Rockefellers Do? DeAndre. Thanks, DeAndre. Keep on communicating with me. My team's letting me know that you're out there. And we're getting into the differences between the wealthy, middle class, and poor in how they look at money and investing. So Warren Buffett is heralded as one of the biggest investors in the stock market of our time. The reality is Warren Buffett doesn't as much invest in the stock market as he buys companies. So he goes out there and he finds these companies to buy, and then he buys it through the stock market because he has so much money, billions of dollars. And now he has controlling interest. Now he's influence over the board. Now he can implement his own methodologies inside of the organization. And by doing that, he might go and fire a bunch of employees or have someone from the organization use that methodology to do that, put more workload on the existing employees, bump up the shareholder value in the stock price. So he has control over the outcome. He has influence over the outcome. Someone's just going out there and buying the stock market. You buy 300 shares, you're not going to get on the phone with the Koch brothers. You're not going to be able to tell them what the methodologies are. You might get a small vote, which means very little. But the reality is you're not influencing who's employed there, the direction of the company, what that vision is. You're simply an outside passive investor in what's called the secondary market. You're not even buying an IPO usually, which is how the companies raise funds. You're buying from someone who's already bought and wants to liquidate for one reason or another. Either A, maybe they feel like that person absolutely, that stock's overvalued, or maybe that person's in a financial difficulty. You don't really know. You're just buying it, and you're hoping that it keeps going up. So Barbara wants to know, do most companies offer employees the option between hedge funds and mutual funds? No, I mean, most hedge funds, you have to have a minimum net worth or a certain amount of money you're willing to invest. Otherwise, you don't get access to a hedge fund. And we have to be really clear. Some hedge funds are not real hedge funds. Like, there are people that set up something called a private placement memorandum. That means for $20,000 or less, they can set up a fund. They can't advertise it publicly. It's not traded publicly. And they can go out there and make investments. And those investments, they might call it a hedge fund because they have more, options of where they invest than a mutual fund. But the reality is, with that little of money and that few of people, 100 people or less, we've seen so many people lose money there, even though they think they're in a hedge fund. So there's something called a fund of funds, where really wealthy people have multiple hedge fund managers managing their portfolio so it gets spread out even amongst more than one fund manager. So these are pretty important. And someone's asking what my thoughts are on ETFs. As a beginning investor, ETFs, and whether it's real estate, these are exchange traded funds, seem like a good fit. Well, Ken, I mean, the nice thing is the fees are a lot less. You don't have to have as big of dollars to get into them. But the question is, does it align with your investor DNA? Risk isn't in the investment, it's in you, the investor. Do you understand why that investment would win or lose? It's really hard to win and play with ETFs, meaning you're not usually buying and making money on the buy. If you're buying a piece of real estate that you knew was undervalued because someone was in a pinch, they had equity, but they needed the cash immediately because they couldn't make a payment. There's a number of reasons. You might just know that there's 3 rooms if you fix up is going to massively increase the value of that, right? So if you knew that and you can make money on the buy, and then you have control over marketing it or putting in renters in it or selling it, you might have more influence. But if you don't understand that, that might not be a good investment for you. So yeah, it probably has a little bit more than others, you know, a little bit more benefit than a standard mutual fund because of the fee structure, but it still has some of the same issues, a little bit better, but not the best. We'll get to what the best is. So when we look at Warren Buffett, he's buying a company, not just a stock market investor. He's not in it for the long haul by buying, holding, and praying. He's not buying because, you know, through dollar cost averaging every single month. He's acquiring an asset. He's buying a business. And he's just got enough money that he can buy that business and become part of the board or influence who's on the board or what's happening inside that company. Now, what really opened my eyes was at 22 years old. At 22 years old, I went to a family office. A family office was originally designed to be one family having a financial team that worked just for them, like the Rockefellers. So accountants and attorneys and investment advisors and risk managers all working on their behalf. That was a big part of it. But now family offices might take on 10 clients or 20 clients, or might be that many per year. And so it is one cohesive, comprehensive, communicating organization that really does true due diligence. They emphasize tax savings as one of their major benefits because that's an immediate and guaranteed return. They have a way bigger fiduciary responsibility to protect the downside because people have already made the money. And now they're saying, how do we make sure to stabilize that? So they don't usually take as much risk and you don't see as much volatility for the majority of those. So when I saw the very first client that was going through a family office and I was shadowing and seeing this, they were worth $20 million and they were on Wall Street as a Wall Street executive worth $20 million and they had less than $500,000 in the stock market. So let me get this straight. They made their money selling the stock market, but did not put their money in the stock market. There was an expose on Susie Orman not that long ago because she had similar net worth and had very little money in the stock market, yet that was the primary advice that she was giving to put money in the stock market. So the stock market is now involved with, you know, hundreds of companies if you're in an index fund. And we got to think about a couple of things. One, there's something called flash trading, which is a way that skims your return through supercomputers that every time someone goes to buy, they raise the price quickly, you buy, and then it drops back down when they sell. So they kind of just skim it and you end up taking the loss. There's fees that you pay along the way that can really impact your overall return. A downturn or volatility can hurt your overall return because there's a difference between average return and actual return. If you had 100 grand, you lose 10%, you're down to 90 grand. If you gain 10%, you're back up to 99 grand, not to your 100,000, and you lost the time value of money. But the bigger issue is the disruptive nature of technology and what that's doing to the stock market. Big, old, antiquated companies that can't move very fast because it's hard for them to fire a workforce or to innovate as quickly because of how slow moving they are now being disrupted by companies that come in that don't need a fleet of cars to compete with the taxi union, that don't need don't need actual property to compete with the hotels out there. And so all of a sudden we have these disruptive companies that will demolish some of the Fortune 500 over the next 7 to 10 years. That company will go out of business in the Fortune 500, be replaced by this fast growing company. But if you own the Fortune 500 index fund, right, the S&P 500, and then one of those companies goes out of business, you should be at 0% on 1/500th of that portfolio forevermore on the earlier dollars. But they're just going to replace it and then show you an average return of the new company that's getting better returns. So we see average and actual being far different. Average doesn't consider volatility. It's not taking into consideration all your expenses associated with all of this, right? There's just so many factors. And when people think the market's averaged a certain percentage since 2000 BC or over the long haul or over a period of time, we find that what is promoted versus what is realized is completely different. And then we see that the people that are promoting this and marketing this aren't even putting their money there. So here's the methodology I've kind of seen. Now let me just look here. I'm seeing some questions. Let's see. What do you think about using credit spreads as a strategy? James, it really depends on your knowledge and what you do there. Like we're talking about, yeah, that's an offline conversation. Obviously, you've done some research. Can your program work for Canadians specifically? Can I roll over RSP to cash flow banking? Denny, we do have someone that can specifically help Canadians. So just email us, builders@wealthfactory.com. And on that specific question, the answer is yes. On taxes, the answer is not really. I really hope to address any strategies to restructure debt to pivot your interest. Okay, Jacqueline, we'll see at the when I get through this first part. Definitely can do that. Your YouTube ad got me into investigating in a dividend-paying, overfunded whole life insurance to become your own banker. Very interesting, Chris. Great. Yeah, I mean, that's really a concept that I saw a lot of wealthy people were doing. Now they do it in different ways. Because when you're really wealthy, you might be able to do private placement life insurance. See, I met a guy that sold Trump an overfunded whole life policy. But then later on, I said, did you ever talk to him again or sell more? He says, no, they ended up doing a private placement. Private placement, attorneys draft it, and they work directly with the insurance company. They cut out a lot of middlemen, but usually you have to have a minimum of $1 million a year to put into it. But here there's people like the Rockefellers and really wealthy people storing money in cash value insurance policies. So that's pretty fascinating that that's happening. We also see, because they don't have money in bonds, cash value doesn't have capital depreciation like a bond. When interest rates go up and you hold a bond, your bond value can go down. If interest rates go up when you have life insurance, it only increases your dividend. It doesn't decrease the money that's already in there and it's guaranteed, because it becomes more risk-free capital with tax advantages. And hell, we even see that banks are taking a percentage of their reserves and putting it in cash value insurance. So I saw the wealthy people do everything from premium finance, where the bank finances a life insurance policy for them, just like they might finance a home, but their cash value is their collateral, or private placement, or just overfunded whole life policies where there was a lot of cash and less commission. So this was a big part of it because it was very stable and it gave them access to money. So when the right opportunities came along, they could pounce on those ideas. What I saw is most of their wealth was in their businesses. A lot of these people were wealthy because of what they invented with their business and the growth of their business. And then they would take that business wealth and transfer and store that into more stable, secure, safer places outside of their business. Where as business owners, we take plenty of risk. And then you have financial advisors telling you to take money out of your business and other businesses that you know less about, that there's more risk and you're further removed from. And that's not what the wealthy are doing. The wealthy are not taking these exorbitant risks outside of their business. They're investing in things that they know. They're growing that massively, whether that's Carlos Sims, who's now buying companies that relate to the telecommunications companies that he already owns. And he's a multi-billionaire, right? And if you get too diversified, it becomes diversification. We've seen billionaires make major missteps because they're investing in something they know. They get a false sense of arrogance and confidence, and they invest in something outside of that. And because they don't understand that, they lose money because it's not their investor DNA. It's not what they understand. So in my own family, what I've really discovered in aggregating all of these wealthy families over the last 20 years, what I've been able to see, whether it's meeting with Jeff Soha, who's in our elite network, or looking at some of the case studies with clients when I sit down with the coaches, or hearing really cool things that Wealth Factory members are doing, or bad ideas they had in the past that lost them money. Like, we get to hear the good, the bad, and the ugly and learn from that. But what I found was the wealthiest families that pass on for generations, one, is they do have insurance that replenishes their trust, but two, they invest in their heirs. They invest in what they know. They invest in their business, and that's the catalyst for their growth. And then they personally transfer that into safe and stable places. So I just filmed the video for my kids and for my great-grandkids, and however long I have an estate and they know who I am, I put a video out and I'm like, we're going to invest in you. We're going to keep our money safe, stable, and secure inside of the trust because we're making it in our businesses, and we're going to invest in you, the heir, so that you can learn. So you can grow, you make mistakes, you might have some losses, but then those mistakes can be taken, and then you can learn something new and hopefully grow from that, and then you become the type of person that can actually handle the wealth because you're prepared for it, you're a steward of it. When we don't talk about money and finances in families, when we withhold that information and we just act like we're paupers even though we have some cash, you don't prepare your heirs. And if we don't invest in those heirs, they're not prepared for the world that's about to come. And if we're always in a miserly, scrimping, saving, sacrificing state, then we never learn how to be an investor, which is investing as people as your greatest assets. Great businesses invest in amazing employees. Great businesses invest in amazing processes and structures. They don't scrimp and sacrifice and rob that business to go invest in other people's dreams and other people's businesses that they don't even know or control, because that slows them down and diversifies them. It pulls good money out of the business and chases bad money. And business is three-dimensional because you can create cash flow. The more cash flow you create that doesn't require your direct involvement, the more equity that gets created. The more equity that's created, the more value that business has in the future. And your equity gets built by the customer base you serve. So the more value you add, the more cash flow you create, and it becomes this amazing cycle. And so you get that feedback, you can be profitable. And so where is it that you can buy businesses, or where is it that you can find opportunities where you can make money on the buy in the knowledge in the area that you have? I've mentioned on other webinars that Ted Turner sits in cash, sits in massive amounts of cash. And when everything's depressed and down, he bought more land in Montana than any other private individual in history. He bought CNN, he bought the Atlanta Braves, he bought a signage company when it was depressed, when people were illiquid, when everybody else was running to invest because the market was so hot and so good and all ships were rising with the tide, he sat tight. But when it went down and everybody's too reliant on net worth, not focused on cash flow because that's the accumulation model of finance, then what he found was, look, when their net worth is all tied up and they have to liquidate that to create cash flow, I'll be there with the cash to liquidate it, and I can make money on the buy. I can make money because they're requiring the cash because they neglected cash flow. I want you to think as a cash flow investor. How can you create cash flow from day one? If you can create economic independence, you've already won the game. You can swing for the fences in your business because every dollar you earn can be reinvested in that business. Economic independence is enough assets to create cash flow to cover your basic life expenses. It means your active income in your business that you personally earn can be reinvested to grow that without any of that money being burdened to cover your lifestyle. And there's no reason to go speculate with money. There's no reason to go put money into things you don't know or understand, because if that actually works out, it becomes a gamble. Because you go, oh, that worked, I'll do more of that. How do I know? From personal bad experience of doing that in my own life. So we're getting a lot of questions here. And so I'm really happy to see, how do you feel about leveraging whole life policies for investments in rental properties? Look, if you know rental properties, I've used my cash values to buy rental properties, and I've used the cash flow from the rental properties to pay back my cash values, and that is velocity. That could be awesome. I plan to take loans against my policies to pay for the down payments and take cash flow from the renters to repay the loan and cover the interest spread. Sean, I've done it. Just make sure you know what your properties are, like what are your parameters, what are your cap rates if it's commercial, what are your cash flows if it's residential, what's your exit strategy. Be a great real estate investor, and that is an amazing place to store cash until the right deal comes and use it. For entry-level investments with high quick yield, what do you recommend? Well, entry-level investments with high quick yield, like if I'm a business owner, sometimes paying cash gets me a 20% discount. That's hard to beat. Sometimes paying off a high interest rate loan gets me 100% return. If I'm only earning 3%, that's costing me 6%, paying that off improves my cash flow, pays off a loan. I feel better about myself, right? Some of the things could be, you know, some people have done bridge lending where you just lend until someone gets a big loan from the bank, but now you charge points and high interest rates, but you better be really good at that. I've seen people make a lot of money at that. Others are great at taking equity in business because the contribution they give and the money they have, and then they get a bunch of businesses. My friend Mike Geary has done this with multiple businesses with massive value and six-figure net profits from multiple businesses just last year, because it was all related to the industry he knew and supported, some systems he already created, and he had cash that he put out, and he got equity, and he uses his brain to help him out as well, and he spends a little bit of time each week on it. That has been massive. For me, it's licensing my content. Licensing and creating programs for the organizations that support Wealth Factory makes them stronger, make sure that people are more educated. And right now I'm building more legacy videos within Wealth Factory because I'm constantly looking at where can I take intellectual property as my main investment rather than physical property, because that's where my gift is. Where is your gift? Where are your abilities? I know you're not a big fan of traditional IRAs. Do you have a different opinion of Roth IRAs because of the additional tax benefits associated with Roth? Christy, I do feel like Roths are better, but they're still maybe not the best because they're still government controlled. So anyone can do a one-time conversion from traditional IRA to Roth IRA. And if you can get that where it has a better valuation, where you pay less tax on that conversion, now you can say, let's say the government comes out and they say they're going to start taxing Roths. Well, you can just cash that out and get your principal back tax-free. So I like that there's more flexibility that way, and there's a better chance that you get tax benefit than just deferring taxes, because when a really low tax rate right now compared to historical rates, what happens if they jack that tax rate up in the future? What investments are more secure in regards to long-term as well as cash flow in a retirement age, like age 66? Well, Victoria, it really once again depends on your investor DNA. Some people are great real estate investors, some people absolutely suck at it. Few people are good at the stock market, few. Some, most people don't earn that much, and it's a terrible idea at retirement. Other people, they're really good at like buying a business and turning it around. I just know business turnaround specialists that do it over and over again, or partnering on a business. It obviously is more active than passive in that situation. Making sure that you have enough cash value if you start a cash value plan, that it doesn't get eaten away because of your age if it's only a baseline. So less death benefit, more cash value. That might be a place. I mean, there's tax liens, but once again, these are active investments. You have to go research. You have to really look at like, where is it that you have a unique ability? Where is it you have investor DNA? Where is it that it makes sense for you? For me, that's intellectual property. I put all my money in cash value, and that's it. I used to do real estate. I used to do oil and gas. I did 2 IPOs. I had a hard money lending fund. I had over 100 real estate properties, and it consumed my life in areas I wasn't an expert in and things I didn't want to deal with every day. So I begrudgingly did it while it drained my energy in the name of being wealthy. The reality is my wealth is in my vision. So if you focus on purpose and find things that support that purpose, if you know your sole purpose and you align your investments with that, you'll be more informed. You'll be more dialed in. What are you researching all the time? What makes sense to you? What are you passionate about? What things do you find yourself wanting to read about or talk about, or that you can get that nobody else does? My friend Rich is great with technology. That's not me, right? That's not my gift, but it's his. Other people, they're amazing at real estate. Other people aren't. My friend Bob is amazing with real estate. Not really my gift. So you got to figure that out, and you focus instead of diversify. That was the secret of the rich. They focus to build their wealth. And Andrew Carnegie said he put all of the eggs in one basket and watched it like a hawk. And then they grew that basket. Diversification became diversification for people that are in poor and middle class, in mutual funds and paying fees, in retirement plans, but paying higher taxes when they go to get the money, or finding out it wasn't enough of what they thought it was going to be. They neglect paying off, higher interest rate loans. They don't restructure loans. They don't save tax. I mean, here's the key. The best way to win and play: save tax, save interest, save non-performing investment fees, and structure your insurances properly. That's big dollars into your pocket. Automate your savings. Set up a separate account. Pay yourself first. It just goes to savings, so you have liquidity, safety, security, staying power, and it becomes an opportunity fund, just like Ted Turner. When that cash is there and the right opportunity comes, you can pounce on it. And that's the thing to do. Many feel that the economic downturn is just around the corner. I've converted my 401k to bonds and cash, considering not contributing my 401k and savings, saving it instead in a vehicle that I have access to. What do you think of this strategy? Mark, I think it's a great strategy. I do agree. I don't know how long we can go before the economic downturn happens, and here's why I don't know. Because there's too many levers. We can mess with the Fed with interest rates. We can put out programs that artificially hold up the economy. We can put out stories and distractions that have people not understand what's happening. We have a lot of people funding a retirement plan, even if it doesn't make sense and the market's overvalued. We have 7.6 million people more than 90 days late on their car payments. When will that reckoning happen? When interest rates go up or guidelines become more strict of getting a loan, that slows down the economy quickly. So we're on a very frail bridge right now, and it's held up longer because of the hype, the hope, and a lot of, just kind of crazy notions. But that day will come that we see that downturn. Now, downturn means more money will go into other people's hands and less in middle class people and poor people's hands that are not in the know. Don't transfer your wealth. Protect your downside. Don't invest in things you don't know. Make sure you make money on the buy. Think more cash flow than accumulation. Don't just speculate for the future. Jeremy says he thinks I'm excited about this. He likes it. Yeah, I want to bring some energy and passion to this. It deserves it. I'm not angry, I'm passionate, right? Pissed and passionate at the same time. I'm so glad I found your company. This info is life-changing. This is what I've been needing. Peter, I'm glad to hear it, man. Like, to recap, what we're looking at is mutual funds are a tool of the middle class and the poor, riddled with fees, tons of volatility, lots of expenses that are hidden and hard to understand, and market volatility because of companies that will be going out of business due to technology. That is going to be a loser's game moving forward. Hedge funds are a better option for those that can get into them with the right managers. See, it's all about the people you're investing with, not just the investments you make. Next is, don't predicate all of your investments upon a stock market you don't control with no exit strategy, with no downside protection. Warren Buffett buys stocks, but he owns the company. Where can you own a company? Like in one of the downturns, I bought a company. That's a great thing because of a cash crunch, or they're having cash flow difficulties, right? So where can you build that up? Where in your industry can you see trends? Can you have insights? Can you know where companies to get into? Ben is one of our clients, and he invests in the health space because he knows more than almost anyone I've ever talked to around health. So he has a better idea of how to assess what might work or what might not work. Maybe not perfectly, but it's less speculation and more growth. So as we look at this, like life insurance becomes a place to store cash, where there's tax advantages, where you don't have a downturn in the market, where you can access cash when everybody else is losing, and that's when you can buy those assets. I'm new to your products and have read and listened to many of your videos. Does your team set up and demonstrate how to set up a wealth capture account, living wealthy account, wealth creation accounts with clients? Kim, like if you are in any of our digital programs, curriculum for wealth, or cash flow banking, you end up with one-on-one calls, and you can have support in those one-on-one calls. We have everything from our workshops where we show exactly how to set this up, and we have modules for it. Or we have our Freedom Fast Track program or Wealth Architecture Premium program, where you get complete one-on-one and group support to get all of this implemented, depending on your situation. So email builders@wealthfactory.com. They can kind of give you a sense of what might be best for you. But in a wealth capture account, let me make it pretty simple for you and hopefully give you enough. You go to your bank where you're currently banking at. You go on a checking, savings, or money market account. You're looking for return of the money, not return on the money. It's separated from your personal checking, your personal business, so it's not commingled. And every time you get a personal check, whether it's from your business or from your employer, you take a percentage of that and you filter it over. And that automatically pays in your wealth capture account. You're trying to get at least 6 months built up in there. When there's 6 months, you might move some of that into cash flow banking, and go to cashflowbanking.com to learn more about that, because that can boost it 400 to 800%, avoid some of the taxes, and give you more security from a liability standpoint. And then when it gets beyond that, you now have a storage facility to use that cash for the right opportunities when they come along. Hate the stock market. Whole life has been a game changer for us. Well, glad to hear that, Andrea. Is it better to rate a 401k to get out of the IRS and credit card debt? Patrick, yeah. I mean, look, IRS debt, how much does that drain you? You're probably paying a 9% penalty. How much does that burden, weighing on you? And credit card debt is almost always going to be a higher interest rate than a 401k. First thing you can look at would be, hey, can you just borrow from that? And how much could you borrow? And then you'll have to pay that back. Or if you're to cash it out, you pay a 10% penalty. That's a one-time 10%. If that one-time 10% is cheaper than the interest rate on a credit card, you're ahead. If it's cheaper than the interest rate on the IRS, because it's a one-time 10%, where the credit card interest is year in and year out. The IRS penalty is year in and year out. And what happens to your mindset and the freedom, the improved cash flow, the closer to economic independence, not being reliant upon the stock market? Like, I would highly consider it. What's the best whole life insurance company to buy from? Well, Jay, I've got Mass Mutual, Penn Mutual, Guardian, AUL, One America. Those are just a few policies that I have. There's Northwestern Mutual, New York Life. There's some great companies out there. If you go to cashflowbanking.com, they're independent and they can kind of look with our certified specialists what companies match best for you, because your health might be different, your age might be different, how the policy's funded, what kind of flexibility you have. It's more of a unique one-on-one situation that way. Yeah, thanks for all the questions, everyone. And hopefully this has brought you a little bit of insight, a little bit of energy. I know that the light we had kind of was going in and out because I'm moving and bouncing around, but hopefully that wasn't too distracting as I kind of just shared this. I'm doing it here at the Wealth Factory headquarters today, because at the Ripwater headquarters, my intellectual property company headquarters, where I have a little bit faster internet and a little bit better backdrop, my wife was saying the internet was acting up. So I decided to stay here today. You can see that my office is half like a gym here. So we have the Wealth Factory guys come in here and test things out on this bike here, you know, on the weights. We do some office workouts and score it on the board. So just kind of a fun cultural thing. And part of our seeing wealth is not just financial wealth, but it's our health, it's our mindset, it's our relationships and the social network and you know, and the recreation and rejuvenation that we have in life. So we look at this more of a quality of life standpoint, and money is a part of that, but not the only part of that. And legacy is something that you live, not just something you leave behind. And life is too short to be speculatively investing in things you don't know, thinking that just because the majority are telling you, oh, you got to put money in a retirement plan, but the minority that has most of the wealth doesn't do that. The banks don't put money in there. They put it into, you know, loans, and they start creating cash flow. They think more cash flow and economic independence. We think more money on the buy than money on the upside that we don't have that we have a lot less control over. So as you start to realize you could save tax, that could be a major game changer for you. You start to learn when you have the right financial team around you, you can make sure you structure your loans right. And one of the questions were around loan structure. So we believe you take your cash flow index, which is your loan balance, divided by your minimum monthly payment. So loan balance divided by minimum monthly payment spits out a number. That number is your cash flow index. With all your loans, do that individually, and only pay extra to your lowest cash flow index because it will free up your cash flow the fastest. It means you have a cash hog if it's a low number. High number means it's a more efficient loan. And you can restructure loans, like you can refinance a car to pay off a credit card. You can refinance a home to pay off a business line of credit. And all of a sudden you're getting a lower interest rate or better term structure. Or you could take underperforming assets and cash those out and pay off a higher interest rate loan and immediately improve your cash flow. So you can restructure, you can reallocate, or you can even renegotiate, get better interest rates with existing loans so that you're paying less to the institution and keeping more. So that was one of the questions we had earlier. Garrett, hey, as always, thanks for doing such an incredible job. Hope you got my gift. Gary, I did get your gift, man. I really appreciate that. Should I be maxing out my Vanguard HSA? So health savings account could be great because it's pre-tax and you can use it for a lot of different factors around your health. So it just depends on your restrictions, but I like where your head's at. You'll want to talk to the team. What are your thoughts on laddering participating whole life insurance policies that is using the equity in one policy to finance and start another policy? Rob, I've seen that. I personally haven't done that. We have to look at, is it participating or non-participating, because that can impact your dividend. We have to look at like what that ladder is doing as far as, yes, you're getting more death benefit, but is it helping you with access or hurting your access to cash value because of reserves? So I would go to cashflowbanking.com, have them run an analysis on the software, because philosophically I haven't done it, but it's something to definitely look into. A lot of great questions here, a lot of good engagement. We've had a lot of people on here today. I did one of my faster talking days. You know, we had 500 people on this thing today. I love that. I love that you guys are investing in yourselves. Check out wealthfactory.com, stay informed. We'll be doing more of these state of wealths. We'll be coming to you. What are your biggest questions? What are your biggest obstacles? You know, I've been putting out a website, Ask the Money Nerds, where people can type in their questions and we can answer on that. You know, like I've got all these Wealth Factory nerds that we're just doing research for win then play, and I love getting that feedback and knowing where people are at. These kind of things are really great. I love to share this. I love just to have the platform and agenda just to give you value, give you a chance to ask questions, give you a few insights. Some we go really philosophical like today, some we get really nitty gritty and practical. I think there's a fine balance, because hard work and the wrong philosophy still equals bankruptcy. So I'm just going to look one more time if there's any other questions. I want to thank everyone for joining us today. It's awesome having you here. Let's see, do we got any more? What's your number one piece of advice for starting a business? All right. My number one piece of advice is to win then play. You want to offer something at a minimum viable product, whether it's an idea or a concept. Have the very end users be the ones to finance and fund it. They write the check, they give you the feedback, they tell you what they really want versus what you think what they want. You can sell it before it's all the way completed. You have those funds start to build the momentum. Win then play is the game changer. We have entire webinars. It's part of the book that I have coming out, but that's the number one piece of advice. And you got to consistently invest in yourself, in your skill sets. Don't scrimp and save on employees. Hire the very best people when the time is right, and keep your eye on the ball with creating more and more cash flow so you don't scale too quickly and destroy yourself. My investor DNA is real estate. In your experience, what is the most underutilized aspect of a real estate investor? Michael, the most underutilized aspect of a real estate investor to me would be making money on the buy, and cash flow. So figuring out, could you do seller financing? Could you turn it into a retreat center? What are your exit strategies? How do you build a tribe of people that can actually be your bird dogs to find properties? And if you can do a historical easement, you've already won from the tax advantage right from the beginning. So the more deals you can look at and the more people that can bring you deals that you can strategically benefit them for being those bird dogs, and then you be very selective, I think that's critical. But to me, yeah, you've got amazing tax advantages in real estate if you can mark yourself as a real estate professional. You have great exit strategies, knowing about charitable trust, where you can pay zero tax on the sale and everything from 1031 exchanges to other things like that. But man, I mean, just to pick one, there's so many out there. Any suggestion for a good place to park money that's set aside for tax so that it's working while it waits? Approximately 10 grand. Susan, I mean, I put mine in a money market or overfund my cash values is all. Nothing too amazing when it's just sitting aside for tax. Can you repeat that list of 4 things you just said so quickly? Yeah, think about the 4 I's, Jacqueline. First is get money back from the IRS. 93% of businesses tip the government. That's an immediate return. Number 2, interest. Restructure, reallocate, and renegotiate so you pay less in interest. Number 3, that 3rd I is investments. Protect the downside. Set up a trailing stop loss so you don't have to participate in the economic downturn if you're in the stock market. Set up a UCC filing if you lend a business money so you can attach to their cash flows if they default. Get a personal guarantee if you invest into an individual so you can attach to their assets and their income. Protect the downside and eliminate expenses. The 4th I is insurance. Do you have duplicate coverages, improper structure? Where can you find ways to transfer risk in the catastrophic way and save money on the inconsequential things of insurance where you can write a check? Those 4 I's put a lot of money back into people's pockets, and this is what we are expert in, that efficiency here at Wealth Factory. If I'm planning a shift in career in 3 to 5 years and possible retirement in 10 to 15 years, is it worth investing in a cash flow policy for 5 years to just hold it? Julianne, I think you could do, the ideal number is 7 years. If you can do 7 years, you can do a 7-pay test where it's fully paid up and you never put another dollar into it. Ideal 7 years. 5, you better talk to the guys at cashflowbanking.com and have them run an illustration to make sure it absolutely works for you. What's your thoughts on IUL versus whole life to build wealth? Well, Eric, I mean, IUL, I have 23 whole life policies and 1 indexed universal life, which is what IUL stands for, everyone. Indexed universal life, we're doing a special segment just on indexed universal life. I'm writing articles, I'm doing YouTube videos. I've done a lot of conversation around this. IUL has its place, but I look at whole life as an and product. I can put money in and have guarantees. I can have access to my money and have guarantees. I can utilize cash and guarantee my death benefit. I look at IUL or indexed universal life more as an or. I can have that cash in there and I can have it growing with more, you know, whatever the market does might fuel it a little bit more than my whole life, but I don't want to touch that cash because I can negate the guarantees. And the older I get, the higher the potential cost of insurance if I take out that cash value because it's built upon a term chassis. They can raise the cost of insurance as an insurance company. So if you look at the guaranteed side of indexed universal life, a lot of times it goes to 0. I have some great articles on this. Why don't I get this to the team here at Wealth Factory? I got 2 great articles recently. One is like in Wall Street Journal talking about how much IUL let down the older generations that have been in it for a long time. And I think it could be useful as a midterm strategy, just a death benefit strategy, or just a cash value strategy. But because of M&E, mortality and expense, the cost of insurance going up as you get older, and the cost of insurance going up based upon how many people die per 1,000 within your age range, that can be the scariest factor of that. All right. I'm 57 years old. Should I wait the 2 years to avoid 10% penalty? I can pay off my mortgage if I liquidate my IRA. Maybe you can wait the 2 years to avoid the 10% penalty. You could just borrow for now, potentially, if there's a borrowing provision, and then after 2 years, you can liquidate it without the 10% penalty. But, you know, if your interest rate on your mortgage is higher than 5%, it might make sense to liquidate. If it's lower than 5%, waiting could be a good idea. That's a good question, Ron. This is probably a personal decision, but would you place a higher priority on eliminating debt or setting aside 6 months of savings? Andrew, I would highly prioritize 3 months of savings and then paying off debt, because you can go right back into debt if you don't have 3 months set aside. So it was really hard because sometimes you see those interest rates, but I want you to build 3 months and then really you can attack those loans. My spouse and I are 65 and 69. Did I understand that we can use the overfunded whole life strategy, maybe with kids and grandkids as the insurance? Chris, I already have policies on my kids, and they grow that cash value very quickly. So absolutely can do that. That's a great idea. I have a small initial sum of cash to start this whole process. What is step one? Well, Chris, it depends. If you've got a very small amount of money, but you've got some time, we have some amazing programs like our Curriculum for Wealth, which is the step-by-step video process of how to become economically independent. That's an amazing start. We have our cash flow generator, which is a program where you get 4 phone calls with a little bit bigger investment. These aren't things that we just sell at any time on our website, because these are usually invite only because of our capacity and the demand that we have. So just email builders@wealthfactory.com and they can get you in the right hands to have a good conversation. I see even more questions coming in. I love the engagement, and I was willing to stick on here till the top of the hour, so totally happy to do that. Is cash going to be worth anything in the future? What about blockchain and digital money? Laura, I mean, inflation has already been devaluing money for a long time. So blockchain and digital money is here to stay. It's still very early stages, so what's that going to look like? That's why I emphasize liquidity or even hard assets a lot of times. So even cash values, you could be using that and putting that into the right, the right cryptocurrency in the future. But right now it's still really early, still extremely volatile. We're not sure which ones are going to make it. So it's something that you'll continue to hear from us as we uncover and discover, as we figure these things out. My co-author of 5-Day Weekend has owned Bitcoin mine since 2012. He owns thousands of Bitcoin at this point, but he figured out a win then play strategy to make money by mining it. And now he's been more cautious about how he handles it. So definitely some things that you'll want to stay tuned for. Do you take your show on the road, or do we have to come to Salt Lake City? Don, I speak at other people's events on a regular basis. We've even done some of our workshops in Austin, but the big reason we have people come to Salt Lake City is you meet the whole Wealth Factory team. You see our pretty magnificent office. I'm going to brag on it. It looks like a factory because it was a hardware building from the 1900s. It has the most amazing big beams, exposed ceilings, and charm to it. And so we love to have people here, but when I'm going to speak for other organizations, that's one way to see me on the road. I'm doing YouTube videos every day. And if everyone wants to go to my YouTube, just go to YouTube. Don't go to youtube.com/Garrett Gunderson. Go to YouTube and type in Garrett Gunderson channel. I'm putting out videos almost every single day. So have comments if there's things you want to hear. I'm just, once again, committed to this 1 million people to economic independence. So thank you for all your insight. You've totally helped me change my mindset about the accumulation theory. Awesome. Accumulation is wealth equals money times rate times time. It takes money to make money, so people put money away. High risk equals high return, so they take unnecessary risk. Time, they just wait for 30 years, neglecting their life along the way. We're about velocity. How do we increase your output with the same input? That's efficiency and expansion. It means if you're going to live within your means, we look at the 4 I's and save you money on the IRS, interest, investments, and insurance, and then help you expand your means through scale, by identifying what only you can bring to the world and creating a structure to support that around you. When's the release date of your next book? Gary, we're going to pre-sell the book in August, and the release date will be Q1 of 2020. Q1 because we're working with the bookstores right now and our publisher on exactly when distribution will happen, but Q1 we will be pre-selling. I've now got 4 webinars, 4 transcripts that we've heavily modified and edited to read almost like a book. That will be the free reports. We're building a journal. We're creating some really cool bonuses for people to grab the book early. What do you recommend for someone new to this? How do we get started making better investing decisions? Christy, if you go to wealthfactory.com/scorecard, we have an awesome way to help you with investing decisions. If you go to wealthfactory.com/megakit, we got killer resources there on cash flow guides and making sure that you stay in touch with us. And you can always email builders@wealthfactory.com if you want to get engaged and have a one-on-one conversation. We have no debt and only high deductible insurance home. Bam. Do we need to buy life insurance? We have savings in retirement. Well, you don't need to buy life insurance, but you may choose to if it's more efficient at boosting your returns and your safety over a savings account. Love that you have high deductibles on the home auto. I love that you have no loans, but where you store your cash, where you're going to get the most benefits, and at the same time have access to your money. I would go to cashflowbanking.com and check that out. Are all Roth IRAs created equally? Well, there's like 4 different ways that people can get into Roth IRAs right now. One is if you earn under a certain amount of income. One is you do a conversion from an existing IRA. Another is called a backdoor conversion. And so there's they're kind of created equally. It's just that once you convert, you might not have access to your cash like you would if you just start with a Roth IRA. A Roth IRA, you can get your principal out without penalty. But when you convert, there might be a few restrictions. So they're mostly created equally, but you also got to realize there's self-directeds that let you invest in more things, where a brokerage might only give you mutual funds. So where you can invest would be different, and how much money you have access to, depending on how it's set up. Those would be the two main differences. Hi, Garrett, what percentage of money should I put towards a living wealthy account? What kind of account should these funds be in? I would say start with 3% of your income. And then I use a money market. That living wealthy account doesn't sit around for very long. I tend to spend that money pretty regularly. So it depends on how frequently you spend it, but it could be overfunded cash value too, as long as it's the overfunded part, not the base part. Best way to pay for college. Laura, I had a client that bought real estate, put their kids in the real estate, paid him as money manager or the manager of the real estate. They got a tax deduction for that. The kids paid in a really low tax bracket. And then after they were done with college, they still own the real estate, and they were going to use the equity or selling that to pay it off, but now the cash flows paying back the student loans. So that's kind of a cool way. I personally am funding college, if my kids go to college, is through their cash values. I just bought cash value policies. I don't really believe in 529s because they're like a retirement plan with even more fees and a lot of restrictions. I don't like Coverdale plans, a lot of restrictions. I believe in you maximize your personal wealth, and then you have options in the future. Elizabeth says she can listen to me for hours. I'm so glad to hear that. What amazing information. Thank you for all you do. Elizabeth, these comments feel great. I really appreciate it. Really enjoy spending the time with all of you that are investing in yourselves and digging into this. So Michael says he loved the book, What Would the Rockefellers Do? I've now got 3 pages of notes. You lit a fire of interest in me. I've lived paycheck to paycheck for years as a paramedic. I want my own rental company, and this information is amazing. Thanks. Glad to hear about the paradigm shift. Mindset is so masterful at creating more wealth. Some people are playing not to lose, and they hold on to everything as savers, and they usually don't get into financial trouble, but they don't have a lot of financial freedom. Then you get the business owners and the spenders that they work so hard, but it goes right out the back door, and it's like they're on a treadmill. Win then play is understanding and unveiling this so that you learn how to be profitable up front. You learn how to focus on cash flow. Where do you stand with your goal of getting 1 million economic independence? Ryan, I feel like right now we've got about 110,000 people that are on the path. 110,000 people that we're doing something with, for, and in communication with. To get to 1 million, we originally said 2020 through pure ignorance and ambition. I'm looking at it as full economic independence, not just on the path to economic independence, which we said the path. Full economic independence by the time I hit the grade. Right? So we set this in motion. We're making really good progress. We've got plenty to do. So I'm 40 years old. I've got another, hopefully 60 years to dedicate to this, because I don't plan on retiring from it. But love that you asked the question. The best thing you can do is spread the word. Get people to go to wealthfactory.com. Get people to check out my YouTube videos. Get them, a copy of What Would the Rockefellers Do? We've got a great way for people to get a copy of that for just covering the shipping. Right? And so we're actually, we pay more to get that shipped to people than the cost of the book and the shipping overall, but we see it as an investment in the 1 million and building that relationship. So it sounds like we got 50 to 100 more questions. We'll try to answer these in upcoming communications. So I love the interest. We'll make sure that we're reaching out to you, builders at wealthfactory.com, a great resource for you, wealthfactory.com, a great resource for you. AskTheMoneyNerds.com. We're going to be answering questions there. We're just finalizing the email setup today so we can get it to the nerds and they can answer those questions for you. And then obviously you can go to YouTube, open the app and put in Garrett Gunderson channel and subscribe to the one. We're just over 1,000 people because we're really just getting started with it. But that's one of the things. I want to get that to 1 million people. So that helps us with a way to get economic independence to a lot more people. So 4:59, we're just about at the top of the hour. I really enjoyed my time with everyone today. Keep looking for these state of wealths. Let us know what you're dying, what topics do you want, what did I do to my thumb? Oh, sorry, someone left these on the table. They're just like, I don't know, I'm like a child. I just play with things that are right here. So I didn't even realize I was doing it. I break paper clips. I take apart like different things that sit on the table. And these are just like, I don't know, they probably came with some of the gym equipment you see back here. and they were just here. So sorry if that was ruffling or seemed like I hurt myself. I'm actually, I'm pain-free right now, so that's great. All right, take care, everyone. Garrett Gunderson signing off. Live the life you love.